Hi everyone. Today we'll be discussing the accounting equation. Um, don't forget to like, share, subscribe. All right, let's get right into it. The accounting equation is pretty straightforward. It is assets equal liability plus owner's equity, also known as equity. All right. So Investopedia defines asset as resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. So, asset is something you own, something that has a value that you could exchange it for something else. So, it could be something you physically own or something that is owed to you. So, like somebody owes you money, you did a job for someone and they're going to pay you, you could consider that an accounts receivable, which is an asset. So, assets, here are some examples of assets. You have cash, cash equivalent, cash you could buy stuff with. That's an asset to you. Like you could trade that for more assets. Um, Buildings, you own it, it has a value to it. Land also has a value to it. Accounts receivable, I mentioned that earlier. If you do a job, if you work for a company, you do your 40 hours this week, you know you're going to get paid. That's receivable. That's something you'll get. That's an asset. It has a value to it. Inventory, self explanatory. Vehicles, equipment, patents, that's an intangible asset. So, meaning it can't touch it, but yeah, it's an asset just like copyright. So say you're a YouTuber, um, you put your content out there, it's yours, it belongs to you, you're collecting money from it. Um, that's an asset, and if someone was to illegally use your content, you could get some, you could get something back from that. So here's a list of some examples for um, liabilities. So, say you have your business, um, you got your inventory from your supplier, you got your invoice, but you have yet to pay it. So, that would be something like an accounts payable. So, that is a debt that you owe. Wages payable, you have your employees, they do their 40 hours, um, but you haven't issued the check yet. That's wages payable. That's something you owe to them. Interest payable, you have your credit card and you know you owe on that. Interest payable. Um, so bills payable could be any example that I've used. I think that's pretty self-explanatory. So to sum it up, might be repeating myself, but liabilities is anything owed. So it's a debt that you owe and you have to settle, or you have yet to settle. So you're liable to pay it. So we've talked about asset, we've talked about liability. We said the equation is assets equals liability plus owner's equity. So in other words, equity equals asset minus liability. So what we have left um, after paying off our debtors, it would be the equity in the company. So you have some examples are retained earnings, common stock, and preferred stock. All is saying that after you pay off your debt, this is what you have left over. All right. So here we have an example, right? So we have a car here. You go to the dealership, you see a car that you like. Um, you put, you take out a loan for 20,000, and you put 5,000 down. So that adds up to 25,000, right? So you have a car, um, and we already mentioned in my previous slide, we said vehicles is an asset, correct? Um, that's something tangible, something has with a value. So the value of this asset, and we're not talking about depreciation. We're not going to get into that. That might be a future video, but let me stay on task. So the asset is $25,000. You took out a loan for 20,000, so that's what you owe. So your liabilities would be 20,000. And we said asset equals liability plus owner's equity, right? So because you put the 5,000 down, um, that leaves you with 5,000 in equity. So let's just say that cars don't depreciate in value as soon as you take it off the lot. Say you were to sell your car for $25,000, you would have 5,000 equity in it. So you would sell it for $25,000, and you'll get back that 5,000 because that's your owner's equity after you pay off 20,000 on the car loan, your liability. So we say asset 25,000 value of the car is equal to the liability, which is 20,000 plus your 5,000 deposit owner's equity. So it balances out. That would be your balance sheet. The asset would be on the left, liabilities, and then owner's equity. It always has to balance out. So 25,000 equals 25,000. If you have any questions, any comments, please feel free to post them. If you like the content, subscribe, like, share. Let me know any other topics you want me to cover. Alright, thank you for watching.